Every day, millions of crypto traders believe they are competing against one another. But the reality is far more complex. Modern financial markets are driven by liquidity, algorithms, and institutional capital. If you don't understand how liquidity works, you may find yourself making decisions that benefit someone else's strategy instead of your own. Have you ever noticed that just after you buy, the market suddenly drops? Or that the moment you panic and sell, the price quickly recovers? While no single explanation fits every move, professional traders know that markets often seek areas where large amounts of buy and sell orders are concentrated. This is where liquidity becomes one of the most important forces behind short-term price movements. Today, we are going to explore how institutional investors think about liquidity, why large market participants approach buying and selling differently from retail traders, and how understanding these mechanics can help you avoid some of the most common mistakes made in the crypto market. First, we need to understand what institutions are actually looking for. Retail investors often focus on percentage gains. They dream of doubling their portfolio or finding the next coin that could generate extraordinary returns. Large institutions operate under a completely different set of priorities. Their primary challenge is not finding an asset to buy. Their challenge is finding enough liquidity to enter or exit positions worth tens or even hundreds of millions of dollars without causing excessive market disruption. Imagine an investment fund attempting to purchase $50 million worth of Bitcoin or another digital asset. Executing the entire order at once would likely push the price higher before the position could even be completed. Instead, professional firms frequently divide large orders into many smaller transactions, spreading execution across different price levels and periods of time. This approach helps reduce market impact while improving execution efficiency. Because of this, institutional traders often pay close attention to areas where liquidity naturally accumulates. These are locations on the chart where many market participants have placed buy orders, sell orders, or stop-loss orders. When price moves into these zones, trading activity tends to increase dramatically. This explains why markets sometimes appear to break important support or resistance levels before reversing direction. Such moves are not always evidence of manipulation. In many cases, they reflect the market's search for available liquidity. Once sufficient orders have been executed, price can stabilize or even reverse as buying and selling pressure changes. For retail traders, these sudden moves often create emotional reactions. Fear replaces discipline. Long-term plans are abandoned in favor of impulsive decisions. Yet professional investors usually approach these moments differently. Instead of reacting emotionally, they ask a simple question: where is the liquidity flowing? Understanding this single concept changes how you view every chart. The second battlefield is not found on the chart itself. It exists inside the minds of investors. Financial markets generate an enormous amount of information every single day. Headlines compete for attention. Social media amplifies excitement during rallies and fear during corrections. Influencers, analysts, and commentators all offer different explanations for the same market movement. Professional investors recognize that headlines often describe what has already happened rather than what is likely to happen next. Instead of relying exclusively on news, they combine multiple sources of information, including market structure, liquidity conditions, macroeconomic trends, and on-chain data. During periods of strong optimism, retail participation often increases rapidly, as investors fear missing the next rally. During periods of extreme pessimism, many of those same investors begin selling simply to escape uncertainty. Institutions understand these emotional cycles. Rather than allowing headlines to dictate every decision, they focus on probability, valuation, and long-term positioning. This does not mean institutions are always correct. They make mistakes like everyone else. The difference is that their decisions are usually guided by structured risk management instead of emotional reactions. Another area that deserves special attention is leverage. Leverage is one of the most powerful tools available in financial markets, but it is also one of the fastest ways to lose capital when used without discipline. Many retail traders see leverage as an opportunity to multiply profits. Professional traders see it as a tool that must be managed with extreme caution. When leverage becomes excessive across the market, volatility often increases. Large price swings can trigger waves of liquidations as highly leveraged positions are automatically closed by exchanges. These liquidation events can accelerate market moves in either direction, creating sharp declines or rapid rallies that appear dramatic to anyone watching the chart. This is why experienced traders rarely focus only on price. They monitor funding rates, open interest, trading volume, and liquidation data to better understand how much risk has accumulated across the market. These indicators help provide context that price alone cannot. One of the biggest mistakes retail investors make is assuming every sudden move represents a new trend. In reality, some moves simply reflect positions being forced out before the market establishes a clearer direction. So how can individual investors respond more intelligently? First, stop placing your entire portfolio into a single position. Even if your research is strong, uncertainty is part of every financial market. Diversification and proper position sizing remain essential. Second, consider scaling into positions over time instead of investing everything at one price. Dollar-cost averaging cannot eliminate risk, but it can reduce the emotional pressure of trying to perfectly time every market bottom. Third, learn to observe on-chain activity alongside traditional market data. While on-chain metrics should never be used in isolation, they can provide valuable insight into long-term holder behavior, exchange balances, and broader market trends. Looking at multiple data sources often creates a more complete picture than relying on headlines alone. Most importantly, develop a repeatable process. Professional investors rarely depend on predictions. Instead, they build systems that allow them to respond logically as new information becomes available. They understand that protecting capital during uncertain periods is just as important as growing capital during strong markets. The goal is not to win every trade. The goal is to avoid the mistakes that remove you from the market completely. Successful investors know that patience is a competitive advantage. They understand that missing one rally is far less damaging than suffering a catastrophic loss caused by emotional decision-making or excessive risk. Markets will always fluctuate. Headlines will always change. Opinions will always conflict. But liquidity, risk management, and disciplined execution remain the foundation of long-term investing. At Whale Mind HQ, we don't chase sensational headlines or emotional narratives. We focus on understanding how capital moves, how institutions manage risk, and how market structure influences price behavior. Our objective is simple: to help you think more clearly, invest more rationally, and make decisions based on evidence instead of emotion. The market always leaves clues. Most people simply don't know where to look. Learn to follow the flow of capital. Stay disciplined when others become emotional. And remember that successful investing is rarely about reacting first. It is about reacting wisely. If you found this analysis valuable, consider subscribing to Whale Mind HQ and joining a community that believes data, patience, and disciplined thinking will always outperform fear and hype over the long run.